It's 2 a.m. You're on Zillow. Again. You told yourself you were just going to check prices, but now you're deep into page 17 of listings, filtering for anything under $500,000. And then you see it. 249,900. Your heart jumps, you click, and there it is. The starter home. Peeling 2003 laminate floors. Contractor beige carpet that has survived at least 3 presidential administrations. Fake wood paneling in the basement that feels like it was installed during a clearance sale at a hardware store that no longer exists. The kitchen appliances look like they've seen things. The bathroom tile is vintage, but not in the good way. But it's $250,000. In 2026, that almost feels like a miracle. So here's the question we need to ask, honestly and without emotion. Is this house a deal? Or is it a financial stress simulator designed to turn your life into a long-term struggle for survival? Welcome to Finance Focus, where we run the numbers so you don't accidentally sign up for 30 years of regret. Yes, $250,000 homes still exist. You can find them in places like Toledo, Rochester, smaller Midwest cities, certain southern markets. They're out there. But existence does not equal affordability. Just because something is listed at a price does not mean it fits into a healthy financial life. Today, our mission is simple. We're going to calculate who can legitimately afford a $250,000 house in 2026 without living on a diet of ramen and anxiety. Let's start with the down payment. The traditional rule says you should put down 20%. On a $250,000 house, that's $50,000. $50,000. Now here's the uncomfortable reality. The median American has around $8,000 in savings. That's not a gap, that's a chasm, and that doesn't include closing costs, moving expenses, or the immediate repairs that almost every starter home requires. So what do most buyers do? They go FHA, 3.5% down. That's $8,750. Suddenly, it feels achievable. Suddenly, it feels like progress. But this is where the trapdoor quietly opens. When you put less than 20% down, you trigger private mortgage insurance, PMI. It sounds technical and harmless. It isn't. PMI is a cover charge. You pay it every month. It protects the bank, not you. If you default, the bank gets compensated. You don't. On a $250,000 home, PMI might cost you $120 to $180 per month depending on your credit profile. That money builds zero equity. It doesn't improve the house. It doesn't protect your family. It just exists. And we're not done yet. Let's talk about the subscriptions you never signed up for. Property taxes. They never disappear. They rarely decrease. They tend to rise quietly over time. Depending on your area, you're looking at maybe $250 to $400 per month. Then homeowners insurance. Over the past couple of years, homeowners insurance premiums jumped roughly 24% in many markets. Climate risk, rebuilding costs, inflation, reinsurance markets. Whatever the reason, the bill is higher. That's another $150 to $200 per month. Now let's talk about maintenance. There's a rule in real estate called the 1% rule. You should budget roughly 1% of the home's value per year for maintenance. On $250,000, that's $2,500 annually, about $208 per month. And here's the part people underestimate. The water heater doesn't explode less aggressively because the house was cheaper. The roof doesn't leak more gently. The HVAC system doesn't break with compassion. A $250,000 house has the same systems as a $500,000 house. The price tag doesn't change the physics. So let's run the full calculation. Assume a 3.5% down payment. Assume around a 6.5% interest rate. FHA loan. Average taxes and insurance. Principal and interest land around $1,540 per month. Property taxes around $300. Insurance about $175. PMI maybe $150. Maintenance reserve, $208. That brings us to approximately $2,113 per month. $2,113 every single month. And that's before utilities, before major repairs, before life happens. Now let's make this real. Meet the Smiths. They earn $75,000 per year combined. After taxes, healthcare premiums, and modest retirement contributions, they bring home about $4,400 per month. Their housing-related costs alone are $2,113. Nearly half of their take-home pay is gone immediately. Now subtract groceries, let's say $700. Car payments and insurance, maybe $650. Utilities and internet, $300. Gas, $250. Health costs not covered by insurance, maybe $200. Basic miscellaneous expenses, another $110. What's left? About $77? $77? That's not margin. That's a financial tightrope. Now imagine the check engine light turns on. The repair is $600. Or your kid needs new shoes, $80. Or the dog gets sick, $400. That $77 cushion evaporates instantly. This is where affordable becomes psychological warfare. Because here's the twist. The bank approved them. Their debt-to-income ratio technically fits within guidelines. Which brings us to the myth of the 43% DTI. Banks will often approve debt-to-income ratios up to 43%, sometimes higher. But understand what that means. They are not approving comfortable lives. They are approving acceptable levels of risk for the institution. Being approved is not the same as being secure. Being approved is not the same as being financially healthy. Being approved is not the same as building wealth. It just means the algorithm says you are unlikely enough to default. Now let's zoom out historically. In 1990, the median home cost roughly 3 times the median income. Fast forward to 2026. Home prices are up roughly 400% since then. Incomes are up around 180%. Those lines do not move together. That gap didn't happen by accident. We've been sold a narrative that homeownership is the ultimate wealth-building move, that renting is throwing money away, that if you don't buy now, you'll be priced out forever. But sometimes what we're really buying is expensive jail. Your equity is trapped in a house you can't afford to maintain comfortably. You can't move because interest rates are higher than yours. You can't invest because every spare dollar goes to the mortgage. You can't breathe because one emergency pushes you into credit card debt. That's not freedom. That's obligation with a white picket fence. So here's the empowering part. It is okay not to play the game right now. It is okay to rent longer. It is okay to stack cash. It is okay to wait until the numbers make sense. Real wealth is not a house. Real wealth is margin. It's having $1,500 left at the end of the month instead of $77. It's not panicking when the check engine light comes on. It's sleeping without financial anxiety humming in the background. Can a $250,000 house be affordable? Yes. But not on $75,000 income with 3.5% down and no emergency fund. For sustainable comfort, not survival, you're likely looking at closer to $100,000 to $110,000 in household income or a much larger down payment that dramatically reduces your monthly burden. That's the difference between technically affordable and sustainably comfortable. Now I want to hear from you. What's the so-called affordable price in your city right now? Is it $250,000? Is it $350,000? Is it $500,000? And when you run the full math, not just the mortgage calculator, does it actually work? Or are you being sold a dream you can't afford to wake up to? If you want more deep dives into the real math behind modern survival, subscribe to Finance Focus. Because hope is not a strategy, and affordability is not a feeling. It's arithmetic, and we're going to keep doing it together.